Hello and welcome to the Daily Brief Show by Zerodha. Here we cut through the noise and bring to you the most important stories that move the markets. I'm your host Anurag Bansal, and in today's episode we'll talk about four big stories. In the first story, we'll talk about how SEBI is changing the way the Indian markets function. In the second story, we look at how foreign investors are investing in India. In the third story, we'll take a look at Tata Motors results and see if there are any insights we can take away. And in the fourth story, we'll look at the impact of the CrowdStrike outage that affected practically the entire world recently. So let's begin. In the last couple of months, SEBI has been making a lot of big regulatory changes that could really affect investors and traders trading in the markets. In June, SEBI issued a circular mandating market infrastructure institutions or MIIs to be true to label in the charges that they levy. Who are MIIs, you might be asking? See, MIIs basically include stock exchange participants like NSE, BSE, MCX, and clearing corporations like NSE Clearing and depositories like NSDL and CDSL. On July 30th, SEBI issued a consultation paper seeking comments on measures to reduce speculative activity in index futures and options. Now, some of these are welcome measures, but they can also have unintended consequences on the market structure and also by extension on traders and investors. So, I want to today explain what SEBI is really trying to accomplish and also explain their impact on the stock market. Now, my goal here is not to point out whether the regulations are good or bad, but rather to explain that even good regulations can sometimes have unintended consequences. See, in June, SEBI said that market infrastructure institutions like exchanges have to be true to the label in how they levy charges. This circular impacted the way brokers were incentivized by the stock exchange. See, the stock exchanges charge a slab-wise transaction fee based on the overall turnover contributed by a broker in a particular month. The more a broker's turnover is, the lower the slab of transaction fee on the turnover. Now, the difference between what the broker charges the consumer and what the exchange charges the broker at the end of the month is a rebate. Such rebates are not specific to India, they are very common across major markets in the world. SEBI recently said that this structure is not transparent and brokers can no longer earn such an incentive. The stock exchanges have been asked to charge a flat fee or a transaction fee instead of the current slab-wise charges. This will have a direct impact on prop traders and high-frequency traders or HFTs if the rate of the new flat transaction on charges decided by the stock exchange ends up being higher than the current lowest slab. Moreover, since brokers will also stop earning this incentive, brokerage rates might go up as well, but for that we'll have to wait and watch. Some smaller brokers have already started to increase their brokerage rates, by the way. Now, this story is also applicable for the increase in STT. If you remember, the government in the latest budget had hiked the rate of STT for futures and options. See, proprietary traders and high frequency traders are among the biggest traders across most segments of the market, and they are an important source of liquidity. If STT increases, the break-even point or the amount of money that they need to make per trade before they make a profit also goes up significantly. Now, this means potentially some of these large traders could reduce their trading volumes and move to other areas where there are lesser taxes. This is because the impact of STTs on futures is much higher than that of options. Finally, SEBI recently issued a consultation paper proposing measures to improve investor protection and market stability. See, SEBI is worried about the rapid growth of retail turnover in the F&O segment. This paper is asking for public inputs on ways to reduce speculative retail activity in index F&O. Now, there are a total of 7 measures suggested by SEBI, one of which is to increase the size of the contract for futures and options from the current range of 5 to 10 lakhs to 15 to 20 lakhs and eventually to 20 to 30 lakhs. Now, this would again make trading futures unattractive because the margin required to trade one lot of futures will be much higher. One of the other measures that they have suggested is a reduction in the number of weekly expiries from 6 currently to 2 weekly expiries, one for each exchange. Now, this is a welcome move and it will greatly help market stability. Paradoxically though, people who trade in futures will now start moving to options, and this is exactly what SEBI does not want. See, if the largest traders like proprietary traders, foreign institutions and high frequency traders reduce trading, then the volumes in futures and options will significantly reduce. One Jefferies analyst said that volumes could fall by 20 to 25%, and if this happens, the impact costs will go up as well. Impact cost, by the way, in very simple terms, is the gap between the price at which a buyer is willing to buy and the seller is willing to sell. Now, if this gap is too wide, it becomes an additional cost that traders will have to bear over and above brokerage, STT, and other government charges. Reduced volumes are not good for the development of the overall markets because they make it very costly for people to trade. Now, you could argue that some of these volumes may move into the cash market, which is good, but the F&O segment will really suffer from lower liquidity, which is problematic in the long run. One approach SEBI could take to reduce speculative activity in futures and options is to instead introduce a product suitability framework, which is widely used in Europe and the United States. In these countries, not everybody can trade in F&O. They need to have a certain net worth, trading experience, and they also have to pass an exam before they can trade F&O. And even if they do all of that, there will be restrictions on leverage and how you can trade. So on a closing note, if the outcome of all these moves from SEBI does shrink F&O volumes considerably, the era of brokers offering zero brokerage or unlimited trading plans could possibly be over. These zero brokerage models were only possible because derivatives trading was subsidizing equity delivery investors who could invest for free. But now that brokers can no longer receive exchange volume incentives, and the fact that SEBI is actively pursuing moves to crack down derivatives trading, which will possibly result in reduced trading volume and by extension of which broking revenues, the era of free broking models in India could finally be over. So the Indian markets are definitely entering a very new era now. Moving on to the second story for the day, let's talk about how foreign investors are investing in India. The sentiment about India has never been so bullish, and investors all around the world are trying to get a piece of the Indian action. The headline economic number looks great. Since COVID, the markets have been pretty much going up almost in a straight line. This optimism shows up in the flows. From 2020, foreign institutional investors or FIIs have been net buyers of Indian equities, excluding the year 2022. In 2023, FIIs bought 1.7 lakh crores worth of equities. Now, if you go back to June, a lot of experts were predicting that foreign investors would stop investing in India. Then they said the same thing after the budget as well, given the increase in both long-term and short-term capital gains tax. But none of these predictions have actually become true. Let me explain. See, so far in 2024, FIIs have invested 32,700 crore rupees. Now, if you compare this with the same period last year, FIIs had invested 1.2 lakh crores by July 2023 already. So this year they have been much slower but not negative. We still have 4 months left in the year and things can still change quite a bit. But one of the most stunning developments has been the rise of domestic institutional investors like mutual funds, insurance companies, and pension funds. See, since 2020's DIIs have invested a massive 7.5 lakh crores in India. For comparison, FIIs have invested only 2.47 lakh crores. The dominance of domestic institutional investors is a recent phenomenon, by the way. If you look at the previous decade, FII investments had been much bigger. This shift is due to a few factors. One, investing has never been easier in India. Thanks to Aadhaar, investing has become fully online and COVID was a huge trigger for this. Second, after the pandemic, there was a sudden rush of new investors into the market. In 2020, there were just 3 crore unique investors in India, but as of June 2024, there are almost 10 crore investors. That is a massive explosion of the investor base. The next and a bit of an obvious reason is the bull market. Nothing gets people more excited about investing like the markets going up. Fourth is the growing pool of domestic savings through investment vehicles like insurance, provident funds, national pension scheme, etc. By the way, just EPFO alone invests a few thousand crore rupees a month into equity index funds. Now the big question is, will this party continue for longer? Well, it does not matter if it is DIIs, FIIs or individual investors. Everybody chases performance and the flows will look strong as long as the markets will do well. Moving on to the next story of the day, let's talk about the results of Tata Motors and what it really means for the Indian automotive market. See, Tata Motors, which is one of India's largest passenger vehicles and commercial vehicle manufacturers, recently released its quarterly performance results. This performance report gives us some very interesting insights about the Indian economy's demand situation. So I wanted to use this result to share a few very interesting trends that are visible here. Now, it is still early days for the Indian EV segment, but Tata is a clear market leader in electric cars with a share of almost 70% in new EVs. More than 70% of Tata Motors' profit comes from JLR, which sells luxury vehicles like Land Rover. Now, despite facing some challenges, Jaguar Land Rover or JLR remains a major revenue generator for Tata Motors. This quarter, JLR reported a revenue of more than 76,000 crore rupees, which was up 5% from the previous year. Moving on, wholesale volumes of EVs were down because of the expiry of the Faster Adoption and Manufacturing of Electric Vehicles in India or FAME subsidies. The government had stopped these subsidy schemes because of rampant misuse by auto manufacturers. A bright spot, however, was the sale of the 1-ton variant of the Tata Ace electric vehicle, which is a small commercial electric vehicle in India. Sales were good despite the lack of subsidies here. Next, there is widespread anticipation of a new EV subsidy scheme, but so far the government has not really said anything. Earlier this year, Balaji Ranjan, who is the chief strategy officer of Tata Passenger, had said, and I quote, "The global case studies indicate that support for about 20% EV adoption is certainly helpful. It would be good if this is the case in India as well." Moving on, if a new FAME EV subsidy scheme does come about, not just Tata Ace EV, but Tata passenger vehicles could also see increased demand. By the way, Tata will soon be separating its passenger vehicle and commercial vehicle segments. The commercial vehicle business will then be listed separately on the stock exchange, while the passenger vehicle business will be fully integrated into Tata Motors. The next insight from Tata Motors' result is that they are now focusing on expanding their EV offerings to drive the next leg of their growth. This includes new launches across both Tata and electric versions of Jaguar and Land Rover models. Tata Motors' joint ventures with Chery will license the Freelander brand from Jaguar Land Rover or JLR to create new products specifically for the Chinese market as well. This brand previously was dormant and will be renewed to cater to the local demand for EVs. This might even help Tata improve the muted growth that they have currently in China. Now, despite the bad shape of the Chinese economy, the performance of Tata's China joint venture was quite steady. Moving on to the final story of the day, I want to cover the aftermath of the huge CrowdStrike outage that took place last month. To give you a quick and simplistic summary, CrowdStrike, which is a very popular cybersecurity firm, accidentally released a faulty update recently. This caused a massive global IT outage which affected hospitals, airlines, banks, and practically every other industry you can think about. Companies had to face massive financial losses because of this, and parts of the tech-driven world almost came to a halt that day. Now that it has been a few days and the dust has pretty much settled down, I was very curious to know the real impact of this outage. So I did some digging and found some very interesting insights. I thought I must share it here as part of this story. Starting with the healthcare sector, their systems really crashed very badly. Critical services were delayed and hospitals had to return to manual processes. Estimates suggest that this sector lost about $1.9 billion, which is huge. Moving on, the banking sector also faced a huge problem. Online banking, ATMs, etc. all went haywire that day and they lost around $1.15 billion. The third was the airline industry, which was in absolute chaos. Thousands of flights were cancelled and social media was filled with people stuck at airports with nowhere else to go. Some airlines also started to issue handwritten boarding passes because the servers would not allow them to take a printout. Delta Airlines, which is one of the biggest airlines in the USA, had to cancel over 6,000 flights. According to estimates, they alone lost about $500 million. Next, the retail and the IT sectors also lost about $1 billion. Point of sale or POS systems absolutely crashed and online services went down. This impacted the sales of many stores and restaurants that depend on online billing. By the way, even public transport and government services in some countries were disrupted quite badly. According to the cloud monitoring and insurance firm Parametrics, Fortune 500 companies faced approximately $5.4 billion in losses. On the other hand, insurance payouts are only estimated at around $1.1 billion right now, but this might increase later. By the way, it goes without saying that CrowdStrike's reputation also took a big hit here. Their stock dropped nearly 34%, which is about $25 billion in market value. Probably the only good outcome of this incident is that companies will hopefully now start rethinking the use of proprietary and centralized tools that have the ability to make changes to critical systems. What the CrowdStrike incident has demonstrated is that one piece of software can cripple everything from hospitals to airports to schools, financial markets, and even some small governments. What a scary world we live in, don't we? That's all the news I have for you today. I hope you enjoyed the episode and found value in it. I'll see you tomorrow. Take care and goodbye.